Good afternoon. It is Friday, September 29th, 2023. I'm Stephen Herwire. I'm the owner of Herwire Financial Plans with Direction. Why bother with a financial plan? And this is the second in the series. But first, the market roundup. As of yesterday, the Dow Jones Industrial Average closed at 33,666.34. Year to date, it is up a little over 1/3%. S&P 500 closed at 4299.26. Year to date, it's up almost 12%. NASDAQ 100 closed at 14,709.88, up almost 36%. Gold closed at $1,878.20 per ounce. Year to date, up a little over 3%. Bitcoin index closed at 27,012.1. Year to date, it's up 63+%. US dollar index closed at 103.16. Year to date, it's up 2.58%. 10-year Treasury closed at 4.63%. Year to date is up 0.75% from its year start. And finally, the S&P Aggregate Bond Index, year to date, it closed at 194.4. Year to date, down 0.37%. Some of this I hit last week. I'm going to go over it briefly for those who didn't catch last week. Why bother with a financial plan? It seems expensive. It'll require some work. After all, retirement's decades, years, maybe decades into the future. These are some of the perceived negatives. But because right now, when you're doing setting up to retire one day, you're planning for that once in a lifetime, no do-over vacation, because unless you're Michael Jordan or Brett Favre, it's unlikely you've been retired before. Do you really want the cheapest planner or the one who's doing it for free? And it's more than vacation planning. It's mistake avoidance, because there's things along the way that can wreck your financial life a lot quicker than a downturn in the market. There are also little things that if you're forewarned by a financial planner, it can save you money along the way. Like going to a new doctor, there's an initial examination. It requires work by you and your planner. Good news is, though, the majority of the work done by you will be done up front, and then after that, your planner will take it from there for the most part, with some input from you, but not as much work. Planner wants to chart a course for you and then spot potential train wrecks and plan for them. Also, there are questions that may come up, they may not come up, but if they're unanswered, it can lead to undesirable results. Major components of a financial plan or benefits of a financial plan are Social Security claiming decision, defined benefit claiming decision. Now, the defined benefit is the old style retirement where you retire, they give you the gold watch and give you a check for the rest of your life at least, and maybe the rest of your life and your spouse's life. Keep in mind with these two decisions, Social Security and the defined benefit, you're making a choice for whichever person in the couple lives the longest. Next question helps answer is when to retire. You pick the wrong time. If you retire too early, you could find yourself going through door number one, which door number one, for those who have been on this before, broadcast before, is where you run out of money before you run out of life. With a plan, we can help increase your chances of going through door number two, where you don't run out of money before you run out of life. It will also tell you how much and what kind of insurance is needed for the different stages of your life. And lastly, it does a general investment allocation. Now, it'll spot problems like owning too much company stock. A local company where I live and work, they were a really big employer, had a lot of employees, not so many right now. But at the end of 1999, a bunch of my friends who used to work for this company were millionaires because they owned so much of this company stock and the company did really well. Well, by the end of 2000, they were 100,000aires because they had too much of their money in one stock. One of the investment allocation questions that gets addressed is concentrated investment, where you own too much one stock. And the big thing is you need to spot these things before they're a problem. So questions we're going to be talking about today deals with retirement accounts. If you pull money out of your traditional IRA, will you pay penalties? It's important to know the consequences of an IRA withdrawal before making the withdrawal. Even if you decide you're going to make the withdrawal, you will be able to plan for the consequences. Some of the questions that need answering. How old are you? Are you unemployed? Do you have qualified education expenses for you, your spouse, child, or grandchild? Is this a part of a series of substantially equal periodic payments? Do you have unreimbursed medical expenses? Are you disabled, a qualified reservist, or subject to an IRS levy? Will the distributions be used for first-time home purchase for you, your spouse, child, or ancestor? Will the distribution occur within 1 year after having or finalizing adoption of a child? As you can see, it's complicated. If you have a financial plan, your planner will address these questions and help you figure out the best answer for you. Should I contribute to a Roth or traditional IRA? First, we got to figure out if you're eligible to contribute to either or both. For example, with the traditional IRA, if you or your spouse has a retirement plan at work, there are limits. If you have a modified adjusted gross income, which I will refer to henceforth as MAGI, if you have a MAGI of $218,000 or less, you can put money into a traditional deductible IRA. If your MAGI is between 218 and 228, you can get a partial deduction. If it's over 228, no deduction at all. If nobody's covered at work, then you can contribute up to your contribution limit. The Roth IRA, they don't really care if somebody has a retirement plan at work or not. The limits for married folks are the same as I just mentioned. Basically, below 218, you can do the full contribution. Above 228, you get to do none. If you're single and want to contribute to a Roth, if your MAGI is $138,000 or less, you can do the full contribution. If it ranges between $138,000 and $153,000, you can do a partial contribution. And yes, you guessed it, $153,000 or higher, no contributions. If you want to make a Roth, if you want to have a Roth IRA and you're not eligible, a backdoor Roth strategy may work. Again, if you have a financial plan, your planner will address these questions. And what do you know? We're going to talk a little bit about backdoor Roth contributions. What questions do you need the answer to? You have earned income. By the way, as an aside, if you or your spouse don't have earned income, you can't contribute to any kind of IRA. Are you married? What is your MAGI, your modified adjusted gross income? What other pre-tax IRAs do you have? If you're unable to make a normal Roth contribution, this strategy may work, but it's tricky and you'll need involvement of your financial planner and your tax professional. Again, if you have a financial plan, your planner will address these questions and work with your tax planner as well. Last, the qualified charitable distribution, which I henceforth will call a QCD. This is for those who are charitably minded and don't have enough deductions to overcome the standard deduction. So the questions you need to know the answers to. What types of IRAs do you have? Are you at least 70 and a half years old? And that's not turning 70 and a half this year, but you've already passed the day where you were 70 and a half. Is any of the IRA actively receiving any employer contributions? What's your marital status? Have you withdrawn funds from IRAs during the calendar year yet? Have you made deductible contributions during the year? Is the recipient a private foundation or a donor advised fund? So this qualified charitable distribution can be used with traditional IRAs, simple IRAs, SEP IRAs, and inherited IRAs, both traditional and Roth. So Always consult your planner and your tax advisor prior to initiating this process. But it can be beneficial from a tax standpoint to do this. Employer plan considerations. Have you reviewed your current allocation of investments in your employer plan? And I don't mean just which investments, I also mean from a tax standpoint, because for tax planning purposes, it's important to know, how much you have in Roth and how much you have in non-Roth. Are you maximizing your employer contributions? Be aware of your vesting schedule. What this is when your employer kicks that money in and you leave pretty quickly before after you've arrived, you may not get to keep it all. Matter of fact, it may be a couple, 5, even 6 years before you get to keep it all. And it'd be a shame to bail out of your employer plan a week or two before you're getting ready to hang on to some more of the employer's money. Do you have an old 401k left behind at a former employer? Do you know the 4 options available for such plans? Because they are. You can leave the money in your former employer's plan if permitted. You can roll over your assets into your new employer plan if one's available and rollovers are permitted. You can roll it over into a rollover IRA and you can cash it in. And if applicable, are you taking advantage of health savings accounts and flexible spending or flexible spending accounts? There's 3 stages in your life that you need a plan for. Number 1, your working years. Big important plan or question to be asking is, am I saving enough for retirement? And this is critical. The earlier you know this, the less impact it's going to have on your wallet. And going into retirement and being in retirement, am I going to go through door number 1 or door number 2? Am I going to run out of money before I run out of life? And lastly, does what I worked hard for after I'm finished with retirement get to where I wanted it to? I can be reached at herwirefinancial.com. I do in-person, Zoom, and phone appointments. I'm licensed and registered across several states and can easily add states if there's a need. You can schedule an appointment by pushing the schedule an appointment button. Can be reached via telephone, 518-631-2569. Don't text there. It won't reach me. There's a text number right there on the screen. Opinions voiced in this material are for general information only, not intended to provide specific advice or recommendations for any individual. All performance reference is historical and no guarantee of future results. All indices are unmanaged and may not be invested in directly. All data is believed to be from reliable sources. However, no representation is made as to its completeness or accuracy. None of this is to be construed as tax or legal advice. Consult your advisor prior to taking any action. Information is intended to be educational and not tailored to the investment needs of any specific investor. Everybody, have a great weekend.